Okay, hi everybody. I am myself in a different location than I have been before. That's why we change of surrounding. I am in Los Angeles at my friend's Dario's house, and I just came back from Vegas, so it will be mostly Stephen that talks about today, plus a little update about the conference itself. But anyway, we usually have this tradition where we discuss a little bit about the channel, assuming that more and more people are coming in. But it's mostly an outlook on Bitcoin from a more scientific point of view. That most of these videos that you can find on the internet are. We are trying to apply different methods that people will apply to other fields, of science, of knowledge, using, this math and physics to try to understand Bitcoin. So it's not a traditional TA measures that people use. It's completely different approach, and this comes from our mutual experience, of Stephen and I being a PhD in physics that actually started in a particular field that is astrophysics, but then in their career we moved to other things like Stephen more on the computational aspects, and me on neuroscience, and we were able to see similar pattern to what we see in physics. And then it came to natural to us to also understand financial system like Bitcoin. So this is our particular angle. Anyway, so we can start. Usually, Stephen has a very nice, prepared agenda, so maybe we can look at that.
Okay, I'll go ahead and share screen then. And thank you everyone for joining this evening or whatever your time zone is. Okay, the focus on this is going to be around the difficulty adjustment, which is really also a proxy for the hash rate, for the long-term trend of the hash rate. In the previous show, a couple of weeks ago, we skipped last week because the big conference was going on in Las Vegas, and Giovanni will give us some update and report on that after this. But what we reported 2 weeks ago was that if you look at the difficulty trend, which is a steep power law, and if you limit it to when the ASICs came in, which is in the year 2013, so you have a dozen years, because there was kind of a quantum leap as you went from technology going from CPUs to GPUs and some usage of FPGAs, and then settled on ASICs and transitioned actually during that year of 2013. The ASICs are extremely well optimized. They're actually hundreds of thousands of times faster than NVIDIA's latest GPUs for the particular problem, which involves about, in a single hash, about 1,600 bitwise type, very low level bit manipulation calculations for the double SHA-256 hash. And so what we were looking for was correlations between the difficulty adjustments, so the long-term trend of difficulty, and you can think hash rate as well, since they're essentially the same thing. That's just that difficulty is adjusted in 2 block chunks, and it's just a proportional constant to hash rate, average hash rate. And we found that for the full data set that there was actually a lead, that the difficulty adjustment was leading Bitcoin's price, which was quite an interesting finding for several weeks. It could be 4, 6, 8 weeks, that kind of time frame. But we also know that the bubbles have been coming down in intensity. They've been falling something like a reciprocal law, or if you fit a power law, it's minus 0.83, close to 1 over t, 1 over the age. And if you fit a reciprocal law, there has to be a little bit of an offset at the origin. But it has been coming down. And so, I was very curious as to whether this effect would still persist if we looked at the last 5 years, a 5-year window. So I'm going to report on the findings there. It's going to be more in the bad news category, that the effect seems to have largely dissolved. But I've sandwiched the presentation today with some good news up front and the good news at the end. So the first good news, before I go into the difficulty, which will look at all these different same things that we looked at before if you weren't there, but that includes the power law, the price versus difficulty long-term correlation, and then how the difficulty changes both in the core and the bubble, and then different methods of looking at correlations, including the Granger, which is the lead log, the lead lag, the cross correlation, which includes a lag and lead term, and then something called entropy. And then we'll get to this conclusion that there really wasn't much evidence this time around with just the 5-year data set for difficulty leading the price in the bubble region, which is what we had found before with the full data set. But I'll end with some log periodic models for both Bitcoin and Master, and those will be more in the good news optimistic category. This one is just another chart from Fidelity. I like the charts that they put out, maybe because they're so well color-coded, I don't know. But this is 25 different asset categories, and this is broken down by quarter, but it's year-over-year performance. So what you have is, on a rolling 3-month basis, what is the year-over-year performance? So if we look for the last 2.5 years, the last 10 quarters, out of the 25 categories, Bitcoin had 4 number ones and it had 3 number twos. So it's clearly the best performing and dominant. And the other next best were the Magnificent Seven with 3 number ones and 3 number threes. Ethereum, which is, tends to kind of follow Bitcoin to some degree, number one time and 4 number threes, and gold number one time and 3 number threes. So that's just a reminder that we're dealing with the premier asset here. This is just a little bit more about my comment about how much faster ASICs are than GPUs. And the first introduction of ASICs led to a factor of close to 1,000 jump in performance for the SHA-256 hashing problem relative to the GPUs at that time. But those were in very high level, of, I should say, coarse level of integration with large line sizes. And now the latest chips are down at 5 nanometers and going to 3 nanometers. So they're much closer to the line sizes that we're seeing for semiconductor fabrication for the fastest GPUs. And so if we compare today to NVIDIA's latest server chip, the H200, Blackwell was the code name, it looks like it could produce, and this is an estimate based on actual tests of some other RTX 4090 GPUs from NVIDIA, but it looks like it would produce about 600 to 800 megahertz, mega hashes per second. And the fastest ASICs are above 500 mega hashes, 500 terahashes, which is 500 million mega hashes per second. And the very fastest are up around 800 terahashes a second. So that's actually 6 orders of magnitude, 1 million times faster. So we can confidently say that it's hundreds of thousands up to even 1 million times faster with an ASIC, which means that if you took all of the hyperscaler capacity around the globe, you would not even be able to compete for a single block, against the Bitcoin mining community that has millions deployed. And I'm in the process now of producing the 14th Crypto Super 500 report. I produce these twice a year, and I produce them in conjunction with the two major supercomputer conferences. The upcoming one is later this month in Germany. And so I will report back to this group about, what the content of that is. We have in Bitcoin mining, we have the world's largest decentralized supercomputer. By the way, since May 2020, which is now the 5-year period that I want to talk about going forward for these difficulty measures and correlations, the number of mining rigs probably roughly doubled, and the hash rate grew by an order of magnitude. So this little chart has just the last 5 years of hash rate fit in a regression of log chart of difficulty versus Bitcoin age. This shows it in more detail. So since May 2020, the slope of this line is 6.3, and it has a very small standard error of 0.09. If you run the full set of data since 2013, all of the ASIC era, then it was a 9.45 slope or a 9.45 power law, and that's shown in the smaller chart. That's the full data series. But this data series starts at log age at years of just over 1, which is, more than 10 years, and now we're at 16, and goes up to about 1.2 or so for the log age. So that's what you're seeing. And I've labeled those by mid of 2020, 2022, and 2024 at the bottom. So you see the hash rate growing about 1 order of magnitude. The number of mining rigs, we don't know precisely, but rough estimate is roughly doubled. Very good fit, R squared of 0.96. So that's kind of the backdrop for both difficulty and hash rate during the past 5 years. Now we can break it down into the bubble and the core, and we can also regress against price. And what I find now is that for the bubble, against price against difficulty, the slope is about 0.5. The R squared is not that great. It's about 0.57. But we also are kind of dependent on really one bubble here, right? Which was the 2021 bubble. In 2024, we got a little bit of movement into the bubble zone that did not follow through. That was in the post-ETF era. And now we're poised to perhaps enter that again this year. And so we'll get some more data up there. But right now, it's relatively flat and not as good in R squared. But in the core, it's quite strong. It's an R squared of 0.93, and the slope is 1. So there's a linear relationship the last 5 years between the core power law price and the difficulty. Slope of 1 on a log chart. So that's interesting. In the core, price is right now running proportional to difficulty. Now, overall, sometimes price will run faster, and sometimes difficulty will run faster and will get ahead of itself even as the price is dropping. And that's more obvious in the little chart in the lower right that shows the full a dozen years of data or so, where you see, for example, for that first bubble, which is on your right, that one being the 2017 bubble, you can see that the difficulty keeps rising quite substantially, a couple of orders of magnitude, while price is falling. And the same effect repeated in 2021. But I think the mining community is getting more sophisticated, and so the effect lessened is in the very last bubble. Okay. This is a correlation study for the past 5 years, and this is the residuals. So, what I did was I took the price residuals from the power law. This is the right way to do correlations, is to look at the residuals. So I subtract out the ordinary least squares power law that I just showed you for the last 5 years, and then compared that to the residuals in the difficulty, which is the difficulty adjustment ratio. As you go from one fortnightly or 2-week adjustment to the next, what is that ratio? And it turns out the maximum we ever saw in the last 5 years was 1.2. Now, if you go back to July 2013, you had quite a lot of adjustments that were greater than 1.2, and you had some that were greater than 1.4. So those have gone away. That's quieted down, at least for now. And the correlation went to 0. For the full data set, the correlation was 0.4, but here it's minus 0.03. So it's basically 0. So that's gone away. Then we looked at the correlation by difficulty bands. It's called a Pearson correlation study. This is just in the bubble zone. Most of the adjustments are positive. That's what you expect, but we had some negative ones. And, those could happen on the downslope in particular of the bubble. And we found a much smaller ratio. And in fact, it's kind of anti-correlated. So if you look in the legend on the larger chart, you see the number of data points, n equals 5, and then you see r equals 0.24. These are the correlations. You see n equals 8, r equals 0.06. So the purple color is actually a negative adjustment, and the violet, the light purple color, is also a negative adjustment, and those had positive correlation, unlike what we saw for the large full data set, and the positive adjustments had negative correlation. And then if you just look at the scatter plot, you look at the full data set in the smaller graph that is all the data from 2013, you see it's a much wider scatter plot, and you can even see the positive correlation. And we had, for adjustments from 1.1 to 1.2, we had R equal 0.44. So that's gone away. And in fact, we don't even have any adjustments above 1.1 within the bubble zone. So this correlation has vanished too for the past 5 years. So this is how we do science. We find something, we find it's interesting, and it's great. We're happy about that. But then, we have to then drill down further and see, what can we understand it better? What are the details? And is this still holding up? So the next one we do is the Granger causality. And what we had found for the full dozen years or so is shown in the little chart. And here you want the line to be down at the bottom, because these are probability values. They're actually log of p-values, log of probability values. And if the probability is low, that means it's a low probability that it's a random outcome, and that you can assume that there's some causality or some predictability. And what we're doing is we're testing the difficulty adjustment as leading the price residual. And we're doing that for each of the core zone and the bubble zone. So in the small chart in the lower right, what we found was in the bubble zone, you got a very low p-value at around 4 weeks. And so that was saying, and because it was less than 0.05, which is kind of the cutoff level, which is that dashed line that you see, it's saying that, yes, there was significant causality for the difficulty adjustments to lead the price residuals over the full data set. But in the 5 years, it's gone, and it actually flips here for the 5-year data set, the most recent 5-year data set. And what we see is the red line, which is the bubble zone, is always above that dash line and always above 10% and really above about 20% probability. So it just looks like something happening by chance there. There's no predictable lead. And by the way, you'll see lag in weeks, and that's price lagging the difficulty adjustment. And the green is the core zone. And there we see that in the core zone, there's actually a signal there. So we're below the dashed line, which is the 0.05 level, for half a dozen of the data points, and particularly around 4 to 8 weeks is where the strongest effect is. So difficulty leading has no signal for the bubble zone, and there is some signal from 4 to 12 weeks, but it's in the core zone. So that's a flip from what we saw before. Now, the last, I think this is the last test, is the entropy test. And this comes from information theory. And here, to have a higher entropy is a good signal, and lower is not a signal. So the bubble line, which is the yellow line, shows some signal for the entropy. And this, in fact, is in the bubble, and it is the difficulty adjustment leading the price residuals. And so it's around the 0.04 level. So there's a little bit of a signal there in the bubble. How do you interpret it? You interpret it with this chart that I've got the thing circled in the wrong place. So we've got 0.04, and it should say moderate influence. So we're above weak influence. We're at moderate influence here. What we had before with the full data set is we had values going up to 0.06 for the bubble zone, and again, small values in the core zone. And that 0.06 is at the high end of moderate influence. So we were, for the full data set, for transfer entropy, we were at moderate influence, but starting to border on strong influence. Here, we're at the low side of moderate influence, peaking near 0.05, which is kind of the middle of the moderate influence zone. And there was one more test, the cross correlation with lead lag. And before we had a signal, now the gray zone is just 1,000 shuffled trials, and you can think of it as the random outcome zone. And here, all of the cross correlation values are within the gray zone, which is in these shuffled, random outcomes. So there's no signal here. There's no cross correlation lag in weeks, either positive or negative, for difficulty leading or lagging in the bubble for the prior 5 years. Whereas since 2013 in the lower chart, there clearly was a signal where you'd get up to 0.05 and above, and the random behavior was down at, you'd got to 0.5 and above for correlation, cross correlation, but it was only 0.1 for the random behavior. So that too has gone away. So in summary, the only one that held up was the entropy with some moderate influence, but the others are non-confirming. So overall, we have to conclude that there's not lead by difficulty predicting price in the bubble zone.
Why do you think is change? Why these conditions have changed?
Yeah, so great question. I'm not certain, but I have two thoughts. And one thought, clearly we have less data to work with, so that's some limitation. And then the random zones get larger, right? So it's harder to tease out a signal. So that's the first one. The second one is that the bubbles have been coming down in intensity, and we've shown that the power in the bubbles has been decreasing linearly, roughly, with the age of Bitcoin. So as the bubbles come down, this effect could perhaps wash out. And the third one is just where we're positioned, in the cycle, where we've had this big bubble at the beginning, but our bubble hasn't developed yet. So for 2025, if it's going to, and if it does develop, then, we might see more signal again. But right now, we're mostly not seeing it. And in fact, there's some counter signal where, it works for the core region, but it doesn't work for the bubble region. You have any thoughts on that yourself, Giovanni?
Yeah, there is much more. One thing that could be that. So when you calculated the correlation, did you calculate it with, I guess, with many different lags, right? You're looking for
yes,
different lags.
Yes.
Including zero lag?
Yes.
I see.
Yeah.
Yeah,
Yeah.
it seems that there are I don't have much to add out that the conditions probably are different. The mining in the last few years is becoming more efficient. It has,
Correct.
yeah, one of the things that is happening. So yeah, it's possible that because I did also a Granger study slightly different from yours, and I was seeing some correlation, but only at particular points. But yeah, it's possible that we have lost that, so that basically the conclusion. Because I think 5 years of data, and when you do your power law, you're still considering the genesis as your
the entire power law. Yes, I use the entire history of the power law to calculate the residuals. Yeah.
Right. Okay. Yeah.
Okay. Yeah. No, it'd be
So 5
interesting.
years
Maybe
should
you
be enough,
present some of the Granger work
to
that
see
you
a
did.
pattern. Yeah. Anyway, yep. And you
Okay.
wanted to say something about Sornet?
Yes. So this is the log periodic power law that we've talked about before. This is not the same as the overall power law trend, which is a very simple, 2-parameter model that just has a leading constant, and a power law index is a function of the age of Bitcoin, right? That's a simple 2-parameter model. These are complex models with 5 to 7 parameters, and Sornet developed them not for the overall long-term history and fundamentals, but to look at in bubbles in particular and how those bubbles develop and crash. And the fundamental idea is this periodic word and log periodic, because it's not a period in linear time. It's a period in logarithmic time, or I should say that it has waves, and it's waves and contractions, like you get in an orgasm or something, or some other natural phenomena, right? And the waves become shorter and shorter periodicity as you get to the peak of the bubble and then the crash. So that's the basic kind of idea. But it's got at least these 5 parameters, and I'm going to show you the full 7-parameter models for Bitcoin recently and for Master. But just to remind people, and I did show this slide a few weeks back, you have a trend component, which is the A and the B, and that gives you a price level and a slope. So that's pretty straightforward, kind of linear forecasting. But then you have this long term, which has 3 parameters. It has a constant, leading constant, and it has a cosine function. And then inside that cosine function, there's a log function of time. And then there's a frequency, which is this omega parameter. And that's called the log frequency because it's multiplying this logarithm. And then there's a phase term, which is the phi. So that's what governs the oscillations. And in the chart, I had applied it to all of the Bitcoin history. So trying to span the three first bubbles, and really the fourth one as well. It fit that too. So that's got the 2011 bubble, the 2013 bubble, the 2017, and not shown in a color, the 2021 bubble. It fit them pretty well, but the detailed oscillations didn't fit too well. But that was with the 5 terms. Now here, this is Bitcoin, and this is just 1 year of data plus projection. So I've taken data from the end of May 2024 through the end of May 2025 and fit it with the full model that has 7 parameters. And the additional changes are that there's a critical time, and that critical time is when your crash would occur. And what you do is you measure time backwards from the critical time. So you have the current time t, you have the future critical time, and it's the difference of those that then enters into your equations. And it enters in 3 different places. It enters into the linear term, which is this B term. It enters, and that has a power law index. And that index is this M. So what you do is you actually take a power law for that linear quasi-linear development of the slope up. And then you add the big oscillatory oscillatory term that's led by this C. It also has this power law, which is the difference between the critical time and the time to day. And all this data is in days for this one, multiplied by, raised to the power of M. And then you have your oscillatory term. And basically what happens is it gets faster and faster because you're taking a log of the ultimate time TC minus T. And once it gets to 1 day, when you're 1 day before, that log is 0. And once it's shorter than that, it blows up. Because log of 0 is, negative infinity, right? So this is predictive up until kind of 1 day before or a few days before the time TC. So it does a fit in order to determine what we're quite interested in, which is this TC date of when, we would hit a peak and your bubble would start to collapse. And then you have these waves, these oscillations that get faster and faster, governed by this frequency parameter, omega. Okay, so the first term A is actually a log of a general price level. And it found for the best fit, and it has to do thousands and thousands of iterations to solve this. It's kind of tricky. But it found a value of 12. Now that's a natural log. So you take E raised to the 12th power and you get 186,000. So that gives you a rough idea of where it's headed. And then it has this kind of B parameter that had actually a negative value. It didn't contribute much. And then the thing we're really interested in is this critical time. And it turned out to be 555 days after the end of May in 2024. So the expected critical time turns out to be New Year's Eve this year. And, omega 9.75, that's governing how fast these things repeat. And then you can say, okay, you found these parameters. What value is it going to have the day before the peak? And it turns out to be 178,000. Not surprising that would be close to the 186,000 level. And you can see visually that it's in the 180,000 time frame. Also, when it charts it, it tends to not run all the way up to the final day. So the visual peak is a little bit higher, but then there's going to be some very rapid oscillation there. So what the log periodic power law series is saying for, using 1 year of daily Bitcoin data with Sornet's model with all 7 parameters, it's saying a peak on the last day of 2025 around 180,000. Now, like I said, this is a very sensitive kind of model. So we did a stability test. And what we did is we started with just the first 60 days of the 1 year period. So back, from the end of May through June and July, that data set of last year. And we said, what are the values of the key parameters? And the key parameters we're looking at here are the critical time, the exponent to which you raise the difference between, today's time and the critical time. And then the frequency parameter, which is this omega. So then we add data in chunks of 20 days until we get our full 360 day or so data set. So this is plotting for these 3 parameters, values with only 60 days of data, then 80, then 100, then 120, and so forth. And what we see is, as we got more and more data, the critical time kept being pushed out further into the future until it exceeded 500 days once we had 320 days worth of data. And then it kind of flattened out, which is a good sign. And then the exponent, which is the red line in the middle, jumped around a bit, but that also flattened out at something between 0.5 and 0.6. Certainly once we got past 250 days, it was pretty flat. The other one jumped around a bit. That's the frequency parameter. It went from nothing up to 1 and, up to 1 and then back down to nothing, then back up near 1. And it ended up ultimately, make sure I've got that right. Ultimate value was 9.8 for the frequency. So there was a little bit of jumping around, but overall, it looked like we reached a fairly stable environment as we added more and more data. So we can have a little bit of confidence in the forecast.
It would be amazing if we actually. I mean, every time we have an episode, we need to show the next piece, right?
Yeah, of course, we need to keep updating and monitoring.
Yes.
And so let's go back actually, and so we should see, in order to confirm this, we want to go above 120,000 sometime this month, right?
Yeah.
That would at least be some confirmation. It doesn't completely destroy the model if we don't, but it would be confirming if that happened.
Mm-hmm.
So expect that, and expect another dip, and then more rapid rises and dips. Okay, and then this is MicroStrategy, now called Strategy, 1-year price data as well. And it runs from the end of May 2024 to the end of May 2025. And there's the set of parameters. And the critical time here was 572 days, and it took us up to end of November. This one was even trickier. It was harder to get this one to converge, and it took 10,000 trials to converge and multiple runs, and a little bit of it kind of bounding itself. But it predicts end of November, $940 as a rough peak price. And now we're what? And we're in the high 300s. So, it's not a factor of 3, but it's a factor of 2.5 or so, and a bigger ratio than you see in Bitcoin itself, which you would expect. So there's some expansion of the MNAV, right? Which right now is a little below 2 for Strategy. Okay, and this one is even noisier. I ran for Similar Scientific. It's kind of interesting. So it was saying Christmas Eve, the end of December, and a peak not higher than where it's been, $70. Now, this is less of a pure play, right? Because they haven't stocked up on Bitcoin to the same ratio. They're running a profitable business as well. So it's harder to value based on just its Bitcoin holdings. And in fact, I ran this through with data up through last week, and the price, I think it was last week. No, it was just actually the end of May. Yeah, also last week. But the price has collapsed a bit since then. It's where the X is. It fell to $34. The reason was some news announcement that, they sold 3 million shares of common stock under an equity offering. And they also paid up. Their last Bitcoin purchase, average purchase price was 109,800. So they bought the top. So they've kind of broken the model. Well, they would need to run back up towards 60 to confirm the model here. But it gives you a feeling for how kind of sensitive this is. And you need to keep up. If you're going to try this, you need to keep updating your model. Okay, so overall summary and conclusions. Is difficulty leading? Well, the predictability that we saw long-term, where difficulty led price, has evaporated with only 5 years of data. The difficulty adjustments are much smaller than they were before, so there's less of a forcing function there. In the Granger causality test, there was no difficulty leading for the bubble, but in fact, there was lead in the core with 4 to 8 weeks. Transfer entropy did show a moderate influence in the bubble zone, but all the other correlations were negative. So lower volatility may have suppressed the long-term correlation of difficulty leading in bubbles. And also the mining activity is more, it's more industrial, well funded with venture capital, and they may be less likely to allow difficulty to run up on them relative to price. And long periodic power law projections for Bitcoin and Master show right at the end of year peaks and basically very late November and very late December, and around 180,000 and 940 respectively. But they're quite sensitive to parameter shifts and because we don't have a lot of these waves yet in the collected data, we're going to get a better feel as we get a couple of more waves of data. Okay. With or without bubbles, there's still going to be a power law.
Mm-hmm. That is good.
So
And
first rule is to be a stoic. Don't be too twitchy.
I like the periodic power law because it's so interesting that it's basically confirming what we already discussed in the past, right? And where we're expecting the peak to be, seems a confirming signal, so it's very interesting. And also, there are similarity, right, between MicroStrategy and Bitcoin, but it's interesting that even that, right, we were perfectly in agreement. So is that what you also conclude?
Yeah.
That it's interesting
No,
that
I think
everything converges. Anyway, yeah, so this, and it will be really interesting to follow over time, how the signal works, if it is consistent. We should compare, of course, the new calculations with more data and the previous calculations to see how much of a convergence we have. I think there is a bit of a delay between us, right?
Yeah, no, it'll be like a once a month kind of recheck, right?
Right. Okay, so and yeah, I don't have much to report this week, unfortunately, because I was traveling. I just come back, and it's not the easiest thing to try to study Bitcoin while you're moving around. But yeah, the conference was interesting. I was expecting more announcement or talks that were more concrete. There was a lot of cheerleading, but I mostly go for social interactions. You meet a lot of people that you interacted online, and you meet them in person. It's a completely different experience, so it's very interesting. But we did have an event. I'm working with this company that is developing this trading system based on the power law. And so we did our own event actually during the time that Sailor was supposed to talk. So it was a very tough competition. But, I think about 60, 70 people showed up. And it was actually a very good introduction to the power law. So I will upload that, to YouTube eventually, the presentation. But we had a very nice crowd, and it was a very interesting event. Mostly a lot of people that maybe follow me on X, etc. So yeah, I really like that opportunity. It's different when you explain these ideas online and when you do it in person. When you interact, see the reaction of the crowd and so on. So it was a very good experience. We can look at some of the questions. Let me see. All right, maybe this one. So, guys, what do you think about Bitcoin stalling in the 100 range? Still think that we hit 200 this cycle, or is LP fading away? So maybe, given that you made very nice, precise predictions, right, of these oscillations and where we are going, maybe you want to comment on this, Steve.
Yeah, I think hope is not faded yet. I would like to see it break clearly to 120. That would confirm what I just showed. And I would also like to see it break out in gold terms. In order to get into bubble zone in gold terms, we need to be at 40 ounces. So those are a couple of things to look for. But if we don't have a bubble, nil desperandum, one should not despair if we don't have a bubble.
Yeah.
Because the very first chart I showed, you own the world's premier asset with no counterparty risk that is growing long-term as a power law, where it goes up 3% every month with very high confidence for the trend, and very high Lindy, very high anti-fragility. And we've got this rush of corporations coming in to add to their treasuries. Every couple of days there's another one. And so, just know that time is on your side. But understand that it's power law time. It's not exponential time.
Exactly.
The exponentials come and go. The exponentials are metastable. They're not persistent.
Correct. So I think this is it. We have a few more comments about quantum logic. I don't know if it's the right analogy, but yeah. Do you have any comment on that? I don't know if.
I'll leave that one to you.
Yeah, I'm not sure it's a good analogy. With between the Bitcoin math, the math that we are revealing, it's really classic math, right? It's a classic behavior of systems, and it's very universal. It doesn't have any direct relationship with quantum mechanics. So yeah. So I don't think we have any other proper questions. So it was a great show. I'm very, very interested in this projection because we are so precise, right? Even major retracement of a price and a sequence of oscillations. So it's.
I want to warn people if they run this. I ran these on ChatGPT with a subscription model, and I also ran them with the free. And the free doesn't run as many iterations, and so the results are not good quality. So if you're going to run this, you should have a subscription to whether it's Gemini or ChatGPT or some other service.
Free version. Yeah. Okay. I will try actually to replicate them myself. I actually have a Python code to do that. So actually it will be interesting to compare results.
Yes, indeed. And, I've run these, in my own environment in Python, and then I've run them in the chat environment both. And you also want to compare those.
Very good.
Yeah.
All right. Thank you. So I will work out. Maybe we can compare them next time when we have our next episode. All right. Thank you, everybody, to stay with us for this presentation, and we will see you next time.
Thank you
week.
all.
Bye, everybody.